Imagine the spot price of silver holding steady at around $30 per ounce, while physical dealers report premiums spiking 50% overnight, forcing buyers to pay $45 or more for actual metal. That's not a glitch, it's a fracture. Institutional flows into futures contracts hit record shorts last week, compressing paper prices by 8% in 48 hours. Yet global inventories dropped another 12 million ounces, the sharpest drawdown since 2011. Central banks accumulated 1,200 tons of gold in 2025 alone. But silver's industrial pull from electrification projects drained stockpiles without replenishment. This isn't equilibrium. It's a system buckling under its own weight. Right now, as supply chains reroute around geopolitical choke points, and the paper game fails to contain the bleed, the rules shifted in the dark. Overnight position limits on derivatives tightened by regulators, supposedly to stabilize. But instead, they ignited a scramble that exposed the hollow core. Banks bet on suppression, and the market just laughed. This disconnect isn't new, but its acceleration signals a deeper rupture. Look back to 1979, when silver surged from $6 to $50 in months. Not because of some isolated hunt by speculators, but because the system's debt machine overheated, forcing a repricing that no policy tweak could halt. Today, we're seeing echoes. Sovereign debt globally exceeds $300 trillion, with service costs eating 20% of budgets in major economies, limiting any aggressive rate hikes that might crush inflation without shattering growth. Silver's paper price pretends stability, but physical reality bites harder. Miners report output down 5% year over year, tied to base metal slowdowns in copper and zinc, where silver emerges as a byproduct. You can't ramp silver production independently. It's locked to those cycles. Meanwhile, demand from solar panels and EV batteries climbed 15% in 2025, consuming 1.2 billion ounces annually, more than total mine supply. That's the anomaly. A market structured for abundance now facing chronic depletion, and the institutions that once dictated terms through leverage are losing grip. What makes this phase critical is how the failure cascades. Banks ramped up short positions in futures to 150 million ounces equivalent last quarter, aiming to cap volatility, but redemptions from unallocated accounts spiked 30% as holders demanded physical delivery. That's not routine rotation. It's a quiet exodus from paper promises. In a stable system, this wouldn't happen. Derivatives would align with underlying assets. But here, the leverage multiplier, often 100 to 1 in these markets, backfires when trust erodes. Geopolitically, export curbs from Peru and Mexico, silver's top producers, added 10% friction to global flows, politicizing what was once pure commerce. This isn't isolated. It's intertwined with energy reroutes avoiding conflict zones, inflating logistics costs by 25% and delaying shipments. The overnight rule change, regulators quietly hiking margin requirements on silver shorts, meant to curb speculation, instead triggered forced covers, pushing intraday swings to 12%. Banks thought they could switch off the surge. The system switched on them. If you've tracked silver futures or dealt with physical premiums lately, how does this misalignment look from your end? Share your observations in the comments, because these ground-level signals often reveal fractures before the data does. Peel this back further, and you see why the old mechanics frayed. Post-2008, the system relied on low real yields to sustain debt expansion, keeping inflation at bay through quantitative easing that ballooned balance sheets to $90 trillion. Gold held as collateral in central bank vaults, but silver, with its industrial tether, was sidelined as volatile noise. That worked until electrification mandates, global commitments to net zero by 2050, locked in demand growth at 7% compounded annually. Now, inventories at exchanges like COMEX sit at 280 million ounces, down 40% from 2020 peaks, while forward contracts show backwardation persisting for 6 months straight. Backwardation means near-term scarcity. In a healthy market, you'd expect contango, where future prices exceed spot. This inversion is a red flag. The system's buffer zones are gone. Historically, during the 1930s depression, silver's monetary role resurfaced amid fiat doubts. But today, it's amplified by industrial lock-in. The kill switch, those tightened rules, exposed this. Banks couldn't flood the market with synthetic supply without risking delivery failures, as seen in the 15% jump in failed settlements last month. Interweave the military angle, because it's no sideshow. Silver's conductivity makes it irreplaceable in radar systems, missiles, and secure communications. Demand from defense sectors rose 8% amid escalating tensions in 2025. That's not public data. It's buried in procurement reports, but the uptick correlates with geopolitical flashpoints disrupting mining in key regions. Compared to the Cold War era, when stockpiles were national priorities, now, Fragmented alliances mean hoarding at the state level, pulling 50 million ounces off market annually. The policy trap deepens here. Central banks cut rates to juice growth, compressing real yields to negative 1.5% adjusted for inflation. But that fuels the very demand that's straining supply. It's a loop. Debt addiction demands liquidity. Liquidity debases currency. Debasement drives capital to hard assets. Silver's asymmetry shines. Smaller market cap than gold, at $1.5 trillion versus $13 trillion, means minor flows cause major dislocations. The overnight shift in rules? It was a desperate patch on a leaking dam, but physical pull overwhelmed it, with dealer backlogs hitting 3 months in some hubs. Here's where the logic snaps. If the system was sustainable, why the silence from regulators on inventory draws? Media frames it as volatility, but the data screams depletion. Global above-ground stocks fell to 3 billion ounces, enough for just 2 years of industrial use at current rates. In 2011, during the last silver spike to $50, similar draws preceded the run. But back then, supply elasticity cushioned it. Now, with mining capex down 20% due to environmental regs, elasticity is gone. Banks' kill switch misfired because they bet on paper dominance, ignoring how monetary fear compounds industrial need. Currency erosion. Dollar purchasing power down 25% since 2020 against a basket of goods, pushes retail into coins and bars, adding 100 million ounces of investment demand yearly. That's the pivot. Symptoms manifest first in premiums and backlogs. Causes reveal in the debt inflation nexus later. For those in finance or commodities trading, if you've noticed similar backwardation in other metals, how do you interpret this as a broader signal? Drop your take in the comments, as these cross-market patterns could confirm the shift. Push deeper into the historical mirror. The 2008 crisis masked metals' role with bailouts, but it planted seeds. Deficits became permanent, now averaging 6% of GDP in developed nations. Silver lagged then, but post-crisis industrial rebound in tech ate into supplies. Fast forward, 2026's environment mirrors 1971's Nixon shock, when gold decoupling from dollar sparked a decade of repricing. Silver jumped 400% in the aftermath, not from hype, but from fiat credibility cracks. Today, central banks' gold buys, over 1,000 tons yearly, signal the same. But silver's industrial overlay adds torque. Geopolitics fractures logistics. Red Sea disruptions alone added 15% to shipping costs, delaying ore from Australia to refiners. The rule change? It was meant to kill momentum, but shorts covering spiked volume 300%, revealing how leveraged positions now amplify failures. This isn't growth, it's a tear in the fabric, where paper claims outstrip deliverable metal by 200 to 1 in some vaults. The behavioral layer seals the break. Institutions rotate quietly. Pension funds upped precious metals allocations to 5% last year, pulling 200 million ounces off exchanges. But retail chases headlines, entering late and exiting on dips. That's the con. System harvest through whiplash. In logistics, trucking delays for bullion shipments rose 40% amid labor shortages, a micro-signal of macro strain. Military tie-in. Hypersonic tech demands silver coatings, with U.S. procurement alone up 12%, yet no new mines online since 2022. Debt ceilings hit. With rates capped, real yields stay negative, eroding fiat appeal. The kill switch flop? Banks lost $2 billion in forced unwinds, per exchange data, proving control illusions crumble when physical reality asserts. If you're involved in supply chain or manufacturing, and you've seen silver procurement costs spike, what does that tell you about the system's resilience? Share your experience in the comments to map this from the inside. Non-linear as it unfolds, the geopolitics market knot tightens. Energy transitions mandate 50% more silver by 2030 for grids alone. But trade wars fragment sources. China's 20% hold on refining capacity, now weaponized via export quotas. Historical parallel. 1914's war onset drained metals from munitions, repricing silver 300%. Now, no full war, but proxy conflicts disrupt 10% of global output. Policy responses lag. Regulators' overnight tweaks ignored this, focusing on financial stability while industrial bleed accelerated. Anomalies stack. Gold-silver ratio at 80 to 1, historically high, signaling silver's catch-up potential. Banks' misstep exposed the policy trap. Addicted to low rates, they can't hike without debt explosions, so inflation lingers at 4 to 5%, debasing currencies further. The loss of control manifests in quiet metrics. Unallocated account conversions to physical rose 25%, a vote against paper. In 1987's crash, similar rotations preceded metals' rebound. Today, With deficits locked in, the system bends toward accommodation, compressing yields and boosting metals. Logistics breakdown. Port congestion in key hubs added weeks to deliveries, inflating premiums. Military demand intersects. Advanced drones require 20% more silver per unit, with production ramps in tense regions. The rule change backfired as it forced transparency. Position reports showed hedge funds flipping long, adding 50 million ounces in net buys. This is the phase where sustainability fractures. Earlier mechanics held via abundant inventories. Now depleted, the system loses buffers. For anyone monitoring central bank moves or reserve shifts, how do you read their gold accumulation versus silver's oversight? Write your interpretation in the comments, as it might highlight overlooked divergences. Weave in the broader reset. Fiat credibility wobbles as purchasing power slips. Education costs up 30% in 5 years, healthcare 25%, while wages stagnate. Gold as thermometer hits 2,500, but silver's gauge screams at industrial choke points. Historical crises like the 2000s dot-com bust showed metals as refuge. But now with debt at 350% of GDP globally, the unwind is slower, heavier. Banks' kill switch aimed to suppress, but overnight rules ignited the opposite. Volatility up 40%, drawing in sideline capital. Geopolitics amplifies. Arctic mining routes contested, delaying 5% of supply. The con deepens in narratives. Media calls it hype, ignoring 15% supply rigidity from byproduct mining. Symptoms dominate. Dealer shortages force rationing, with one major mint halting sales twice last quarter. Causes traced to underinvestment. Capex in mining down 30% since 2015 peaks. Military parallels. Stealth tech relies on silver nanomaterials. Demand up 10% amid arms buildups. Policy illusion shatters. Real rates can't positive without recession, so liquidity returns, debasing further. The flop. Banks' shorts unwound at losses, proving the system's levers jam when physical demand overrides. If you've followed historical metal cycles or seen similar patterns in other commodities, what makes this one feel different? Put your thoughts in the comments, because comparative views sharpen the analysis. Finally, the interlock. Global reserves shift, with emerging markets adding 500 tons of gold yearly, but silver's strategic void exposes vulnerabilities. In 1929, similar depletions preceded volatility waves. Now, with electrification locked and geopolitics fragmenting, the kill switch failure marks the turn. Paper control erodes, physical asserts, and the system enters a repricing grind. Debt forces the hand. Can't cut without inflation spikes. Can't hike without breaks. This isn't the end. It's the midpoint, where anomalies compound into a new normal, heavier than before, with no quick fixes in sight. For those who've positioned in metals or observed market behaviors up close, how do you weigh this physical paper divide in your strategy? Share your perspective in the comments to build out the collective view. COMEX registered silver inventories drained 60% in the final weeks of 2025, with over 47 million ounces claimed for physical delivery in just 4 trading days of December. That's not normal rotation. It's a vault emergency. Spot prices on paper exchanges hovered near $72 per ounce as January opened. Yet physical bullion in Asia and the Middle East traded at $130, an 80% premium that no healthy market tolerates. Backwardation deepened to levels unseen since 1980, with front-month contracts demanding $2 to $3 more than deferred ones, signaling immediate scarcity overriding all storage logic. Regulators hiked margins twice in December, first 10%, then pushing initial requirements to $25,000 per contract, triggering forced liquidations that shaved 17% off peaks. But the underlying pull persisted. China's export licensing kicked in January 1st, gatekeeping 60 to 70% of global refined supply behind state approval. This isn't coincidence. It's the moment paper control snapped and physical reality took over. The margin hikes were sold as volatility management, but they exposed the fragility. CME raised requirements amid record open interest in January contracts, where delivery demands hit highs never seen in minor months. Banks and funds holding massive shorts faced cascading covers, losing billions in unwinds, while physical queues formed in Shanghai and Dubai. Compared to 2011, margins rose 5 times in 9 days, crushing a rally built on thinner fundamentals. Today, industrial consumption locked in 700 million ounces annually, solar alone at 261 million, EVs adding 90 million, while mine output stagnated below 835 million. Deficits ran 230 million ounces in 2025, 5th straight year, draining Western vaults 70% from 2020 peaks. The hikes bought time, but China's move January 1st rerouted flows inward, prioritizing domestic solar and tech over export. Premiums flipped. Shanghai spot closed $6 to $8 over COMEX, backwardation persisting into March. This is where the old playbook failed. Regulators flipped the kill switch to suppress leverage, but geopolitical rationing amplified the squeeze. If you've navigated physical deliveries or watched exchange flows this past quarter, how has the China shift altered your sourcing? Share what you're seeing in the comments, because these shifts often hit ground level first, trace the rupture deeper, and the supply chain fractures align. Mexico and Peru, top producers, faced output curbs. Environmental regs in Peru slowed expansions, while Mexico's reforms deterred capex, dropping regional growth to 5%. China, refining king, reclassified silver strategic, licensing only 44 firms for 2026 to 2027 exports, covering perhaps half prior volumes. That's not protectionism noise. It's deliberate retention for electrification mandates, eating 50 grams per EV, 20 grams per panel. Global installed solar capacity doubled since 2022, yet thrifting couldn't offset volume. Demand compounded 12% yearly. Latin flows rerouted east pre-restrictions, but post-January, Western refiners scrambled. Premiums spiking as logistics costs rose 20%, avoiding contested routes. Military overlap sharpened. Defense pulled 8 to 10% more for radar and comms amid tensions. State hoards off-market. Historical echo. 1940s war drained munition silver, repricing violently. Now, no shots fired, but proxy frictions and trade walls achieve similar choke points. The margin tool, meant to cool speculation, ignited panic covers instead, as shorts realized physical backup vanished. Geopolitics didn't cause the deficit, it accelerated recognition. Central banks added 254 tons gold through October 2025, emerging markets diversifying reserves. But silver's industrial monetary hybrid drew quiet institutional bids. Gold-silver ratio collapsed to 56 to 59, lowest since 2011, signaling silver's catch-up as monetary fear met functional scarcity. In 1980, ratio hit 14 amid debasement. Today's fall from 100 to 1 mirrors that urgency without hyperinflation. Debt loads capped real yields near zero. Liquidity returning despite hikes, eroding fiat appeal. Regulators' silence on draws. COMEX registered dipping below 130 million ounces, spoke volumes. Intervention prioritized financial stability over admitting depletion. Shanghai premiums held firm. Physical exchanges gaining pricing power as COMEX influence waned. This is the pivot. Earlier cycles relied on elastic recycling and inventories. Now, consumed in solder and paste. Silver's above-ground stock supports just 2 years at current burn. For those tracking producer dynamics in Mexico or Peru, if you've seen project delays or export shifts tied to these policies, what does it signal for 2026 supply? Drop your insights in the comments to connect the regional dots. Pressure compounds in the reset phase. Solar commitments, 500 gigawatts annual installs by 2030. Lock 250 million ounces yearly. No substitution viable below $200. EVs tripled automotive takes since 2020. Infrastructure adding grids and chargers. AI data centers spike power demand 50-fold this decade. Hardware pulling conductivity, no alternative matches. Mining rigidity bit. Byproduct of base metals. Silver output tied to copper-zinc economics, facing regs and grade declines. Capex fell 30% post-2015. No quick ramp. China's gatekeeping weaponized this. 60% refined flow now policy tool, mirroring rare earth plays. Margin failures proved the limit. Hikes triggered $10 swings, but physical bid returned stronger. Backwardation reasserting. Ratio compression accelerated. Silver outperforming gold 2-to-1 in late 2025. This isn't mania, it's recalibration after decades ignoring structural drain. The behavioral reveal hardened the break. Funds rotated to physical ETFs. Inflows 95 million ounces. H1 2025 alone. Holdings near peaks. Retail chased dips, but institutions layered quietly. Allocations to 5%. Volatility rose, 40% swings quarterly, but corrections transferred from leveraged to strong hands. Regulators' tools backfired. Position limits slashed, margins tripled entry costs, yet delivery notices spiked. Compare 2008. Bailouts masked, deficits temporary. Now permanent. 6% GDP averages, service 20% budgets. Accommodation inevitable. Yields compressed, debasement slow, but persistent. Silver's torque emerged. Smaller cap, thinner liquidity, dual pull amplifying moves. If you're in tech or renewables and facing silver input costs this quarter, how are procurement strategies adapting to the restrictions? Write your view in the comments as industry signals clarify the depth. Finally, The convergence locks. Global reserves fragmented. Emerging adds off dollar. Gold bids firm, but silver's void exposed dependencies. In 1971, decoupling sparked decade repricing. Today's restrictions echo that credibility test. Margin kill switch aimed to reset leverage, but China's January move rerouted reality. Physical premiums persistent. Paper suppressed temporarily. Deficits project 150 to 200 million ounces, 2026. Inventories multi-year lows. Industrial lock-in unyielding. This midpoint heavies. No apocalypse, but chronic rationing via price. Control illusion shattered. System bending toward higher baselines without reversal. The process grinds on. Heavier. Buffered gone.